Hello everyone and welcome to the FinTech Finance Virtual Arena. And today we've got a very special arena because we're going to be talking about real-time payments which have huge implications on businesses and consumers alike. And joining me I have two experts for this panel. So guys, thank you very much for joining me. First up we have Cyrus Paterwalla from JP Morgan. Cyrus, how are you doing today this morning?
I'm fantastic. It's Friday. I cannot complain.
Absolutely brilliant. And Ed, how are you doing?
Very well, thank you.
Brilliant. So before we go on, I always think it's best if we could get you guys to actually introduce yourself and your roles, your organizations, so that we can understand. So Cyrus, can you tell us a bit more about yourself and your role at JP Morgan, please?
Yeah, absolutely. And it's a pleasure to be here with you, Doug and Ed, today. So my name's Cyrus Paterwalla. I am JP Morgan's Global Head of Real-Time Payments. So that means I'm responsible for all of our real-time and faster payment products around the world in 40 plus countries. A bit of my background, I spent about 10 or 12 years in consulting, doing work all across the globe, building real-time payment market infrastructures, and then also rolling them out for both banks and corporate products alike, which was a lot of fun. And now working for JP Morgan, I'm responsible for their market growth, their product strategy, and expanding the product very, very aggressively. Here at JP Morgan, real-time payments is one of the higher priorities in our wholesale payments business. It's probably one of three top things that hit Jamie's desk on a frequent basis. And it's really around the whole mantra of our leadership of any payment, anywhere, anytime. And that's why we're expanding quite rapidly, growing our product set quite aggressively, and applying real-time payments in the correct use cases across our treasury services product suite.
Absolutely brilliant. And Edward, could you tell us a bit more about yourself and your role and Bottomline, please?
Yeah, Doug, thank you. So my name's Edward Ireland. I work in our product team at Bottomline. We're a leading payments technology company with presence in North America, Europe, and in Asia. I work primarily in our messaging and connectivity propositions. So we're looking at the core messaging services we provide to customers today, and also building out the connectivity propositions that we have in each of the regions where we operate. And I'm also the program lead for our ISO 20022 program, which is going to be a major focus for our customers over the next 2 years.
Yeah, it does really seem like the whole payments industry, from an infrastructure point of view, is absolutely galvanizing. So it's a very exciting time. So thank you very much for joining us here today, both of you. So with that in mind, I always like to start these sessions with a kind of an appraisal of the whole scene before we continue. So with that in mind, Edward, if I could come to you first, what would you say have been some of the biggest instigators in payment trends? You know, have you seen it be customer expectation, maybe new market players, or an industry-wide regulatory push to innovate?
Well, I would say it's a little bit of all of those, actually. I wouldn't say it's any one thing in particular. Certainly customer expectation, that's for sure. I think that electronic payments are widely accepted now. That's not a conversation for anybody now. That's definitely the way forward. And with that is then coming the expectation, the service, and the benefit that can be derived from making electronic payments versus anything else. New market players have definitely galvanized the process, especially if I look at my home market here in the UK and some of the new market entrants that we've seen in here that have really tried extraordinarily hard to come up with new propositions, and that has to have had an effect on the existing players and the propositions that they have as well. And then regulation has had an impact. Some of these changes need a mandate, and things like ISO 20022, the program I said that I'm working on. ISO 20022 probably would have come in naturally eventually, but certainly regulatory drivers and market infrastructure pushes are going to make it happen quicker, and we're seeing that happening now.
Absolutely brilliant. And Cyrus, could I chuck a question to you? What do you think have been some of the biggest instigators in this payments innovation?
Yeah, I think Edward's spot on, but a couple of other additional observations. I think what's interesting is the three examples you used, two of them new market players, actually, in my mind, have been heavily driving the first example of an instigator being huge increase in customer expectations. Interestingly enough, the advent of new market players who don't have a strong or legacy background in traditional financial services has allowed those organizations to approach customers in a different way, less focused on traditional financial products, liquidity, credit, etc., and much more focused on customer experience. When you refocus your attention so fundamentally in a different way, all of a sudden, you create a different set of customer expectations in that part of the market. That has just expanded across the legacy financial services industry like wildfire over the past 8 years or so. So I think it's really interesting that the new market players have actually created the change in customer expectations. I think what we also see is evolution in other industries and how that affects the payment space, right? Payments is an interesting topic, right? It seems like a very commoditized, basic service. We need to move money between people. But at its core, what's really important about payments is not how sophisticated we can make it, or even how convenient we can make it, which is certainly one of the big principles these days. But for me, what's really interesting is the fact that a payment appears in every industry. People don't generally do things for love, free goodwill. They do it to make a profit. They do it to make money. And that means payments exists everywhere we look and almost in every corner of an organization. So if you start to think of innovations in, for example, the motor vehicle space, where we're talking about autonomous vehicles and being able to pay for things from within your vehicle using a more electronified virtual payment mechanism, or even basic things like self-checkouts at a grocery store, these are having a big impact on payments. So we're actually being impacted from external industries changing the way we do payments. And we're also trying to innovate ourselves as we have new market entrants change our customer expectations.
That's a really interesting point you make there, Cyrus. There's the fact that finance and payments especially is embedded in every industry, every vertical. So I think innovation is going to be absolutely huge going on to the future. And then with that in mind, then I was going to ask this question later on then, but Ed, I'm going to throw this to you now. How do you see payments then evolving over the next 12 months, maybe even the next couple of years, because of this swell of innovation from other industries?
I suppose we could look at the 12 months and then look further out. So I think if we look over the next 12 months, some of the regulatory changes that are coming in, and for example, particularly with the ISO 20002 program, there's a huge infrastructure change that has to be put in. Now, for some of the newer companies and the more technically advanced, this is a relatively small change. For some of the more established players, this is forcing a real root and branch upgrade of their infrastructure, which is a good thing. So what we're going to get out of this is really good foundations and building blocks for the new payment solutions that are going to come in the future. So I see over the next kind of 12 months or so in the short term, there's this big infrastructure change that's got to happen, and a lot of investment in the kind of foundations of the new payments world has got to be put in place. And then what we'll see on top of that is, to Cyrus's point, that a payment is in everything. So I think that what we'll see is that it won't be talked about so much as payment processing, but transaction processing. So we'll see the payment as part of the transaction. So we won't be talking about just the payment. So as we do today in the UK on a BACS payment, all we get is a line of somebody's name and how much money is being paid to them, and that's it. So what we'll see in the future is the underlying transaction with the payment with it, with the terms, when it's going to be paid, what has to be paid against, the FX that might go with it, and so on. So it becomes a real transaction rather than a payment.
That's absolutely fascinating, and it just, we've gone from this situation where you don't even, payments is so natural to do with every service to being almost invisible. So, going with that in mind, then Cyrus, can I get your input into where you think payments will innovate in the next coming years?
Yeah, absolutely. Look, I think electronification will continue. There's the typical topics, and that depends per region, because it depends what state that market is in, right? So in the US, where I'm currently located, electronification is very prevalent, but we still have quite a decent number of checks running through our US economy, we have a decent amount of cash running. And there's a whole bunch of legacy reasons for that I don't think we're gonna affect and remove entirely in the short term. But I do think what we'll see is where we do have growth in the electronification of payments, it's going to be driven by customer expectations around more frequency in receiving cash. So whether it's your payroll, whether it's your organization receiving more buy what you eat kind of scenarios from your subscription and monthly services, whether it's the concepts of buy now, pay later, where companies are, instead of receiving in one big hit, they're going to receive over a longer period of time that same revenue, but it increases overall customer satisfaction. Once again, it increases the ability for consumers to buy, especially in a market where we might be facing economic stress and downturn. Certainly we're seeing it in other parts of the world like Europe. And I think more methods of payment, I think that's almost a guarantee at this point in time. I fear the moment where I open up a website to go buy a product online and there's 15 different pay with Amazon Pay, pay with Apple Pay style options. I fear that will occur, but everything that is a challenge is a problem also to be solved as far as I can see. And so I one day assume that we will actually start to aggregate these methods of payments into more distinct wallets, cases like that. And wallets may not be the answer, but today that's what they look like. And I think the other aspect of this is reducing the cost of the commodity of payment. So today we charge, per transaction, for example. Is that the right pricing model for the future for payments? I'm unconvinced that is correct, because the rest of the economic model, when you pay and buy goods and services, like I said, will change to more frequent payments instead of lump sums, more short-term credit-based decisioning. Why would we charge per transaction anymore? Do we need to evolve the way we charge for our services? And I think what's going to be very interesting is moving away from charging just for the individual payment and the cost of processing as transaction processing, as Edward said before, but around the value add to those payments, the ancillary reporting, the ability to cross-sell services, which we can talk about a little bit later today. I think payments, all of a sudden, when you remove their friction, they become an enabler, and they become enabler of value-added services that banks, fintechs, other third parties, retailers can offer. And as soon as that becomes the case, I think that will open up the market to quite a significant amount of change and evolution.
Yeah. Now, speaking of that change in the market and those other players that you just mentioned there, Cyrus, how are JP Morgan looking to evolve from that kind of traditional banking model of doing everything in-house to a more collaborative kind of ecosystem approach, the kind of buy what you require type model, to enable that innovative, almost fintech lifestyle approach?
Yeah, no, it's a great question. And, I've only been at JP Morgan for a little under a year. Joining the bank, it's been an interesting experience as a consultant. I saw banks do both sides of that equation. They would buy everything, vendor-based products, or they would build everything in-house. And there's pros and cons to both sides of that. I think now that I'm on the inside of the tent, for want of a better phrase, what I can see now is the real benefit of building all of our technology ourselves. The agility we have, the ability to pivot when the market demands it or a client demands it, the ability to move quickly, very simply, is, I think, often misunderstood, or more accurately, I think, misvalued. I actually feel it's quite a valuable asset that we have within JP Morgan that I must admit I didn't necessarily see from the outside of the tent. But your question around how will we be more collaborative, I think JP Morgan's a great example where we're doing everything from certainly acquisitions of very talented individuals and companies, but more focused on partnerships these days. I think 5-6 years ago, we were having lots of conversations in panels like these about how we had to compete with the fintechs or they were going to eat our lunch, was the famous phrase. I think the reality is the banks are required in the financial ecosystem, and I don't see an option where that's not required. However, the fintechs do possess a special set of skills, to steal a line from Liam Neeson. And if we know how to harness and leverage those special set of skills by collaborating with the fintechs correctly, working on services like payments as a service, banking as a service, commoditizing the payments and therefore focusing on the value around the payments, That's really where I think your buy what you require model that you referred to will probably really pop up. And that means we can continue building the technology, partnering with really sharp young firms and taking a lot of their intelligence, but packaging that up in a traditional financial services model allows us to really hit a much greater market. If you think about someone like Stripe, for example, their value is not just in processing payments reasonably cheaply. They add a lot of data analytics, end-to-end point of sale, end-to-end customer service. They package up the whole product, and they're actually really selling the customer experience more than just I'm making a credit card payment from one point to another. And I think that's really what we're learning from the partnerships we're having here at JP Morgan.
That's really interesting of you to take, and it's certainly more nuanced, because obviously, as you mentioned before, there was maybe just this one approach or this other approach, and it's interesting to hear that kind of evolve. Now, speaking of, you mentioned talking about having to be able to pivot very quickly. One thing that has been on the minds of a lot of financial institutions, and Ed, if I could throw this to you, it's been ISO 20022. Now, there's been talk about it for many years, but it hasn't been implemented. What are the cold hard benefits for a lot of financial institutions that are looking to migrate to this new standard?
Great, because a lot of institutions have looked at it as something that they just have to do, but also that equally they need to look at what benefit they can get out of it as well. So yes, in many cases it's been mandated by market infrastructure or an institution that they have to use it and they need to upgrade, so they know they have to do it. But so what are the benefits that they can get alongside it? And as we look into these, one of the advantages that we have with a standard now that is much more granular, is more defined, is more accommodating of modern business practices, is that because you can define things more precisely, you get a lot more automation through the process. So even if we look just within the bank's operations and payment service providers' operations, they can get a lot of benefit just from using this standard in terms of reduced operational inefficiency. So there are core efficiencies that can be got from the use of the standard. The second thing that's important, and particularly when we look in a real-time world where we need to do real-time monitoring and we need to protect our institutions from fraud and wrong payments, is that you can be much more precise in how you identify information within the transaction flow using ISO. So you can reduce the number of false positives. You can be much clearer about the payers or the receivers of funds within the data using the new standard. So I think it reduces risk by providing greater clarity of information within the messages. And then the last thing is that by having more information and creating more of a transaction reference rather than a payment reference, it gives you the opportunity as an institution to provide services on top of that transaction. So you understand more about what your customers are doing, more about why they're initiating the payment, and then by association, being able to provide services on top of that.
Interesting. Now, obviously, ISO is just one of the many or myriad of different standards and changes to payments infrastructure as a whole that is happening in the next coming years. So, Cyrus, I've got to ask, do you think that banks that don't embrace the opportunities of these quite sizable tasks are almost facing, I hate to be grandiose with this statement, but almost an extinction level event by the time we get to 2022?
Look, I think the answer is, if a bank doesn't adopt ISO 20022, will they face an extinction level event? Probably not, to be honest. Banks do a lot more than just process payments. I think what I would say, though, is that if the entire market moves in one direction and one bank is left out to the side, that's where you face risk. Now, is that risk of being taken out by your competitors? Is that risk of being split apart and losing your payments business? Yes. Now, once either of those two actions happen, it is very, very hard to get back on course. You lose a payments business as a bank, you ultimately lose your ability to transact value, generate interest rate revenue, let alone the transactional revenue in payments, right? There's some statistics in specific markets, in APAC in particular, where payments revenue accounts for over 60% of large institutions' revenue. That seems like a very high number, but if that bank is not big into liquidity and not big into lending, then payments can make up quite a big part of their P&L. So as soon as you don't adopt an emerging standard and you stance, lean left and everyone else is leaning right, you do risk exposure. And once that happens, it can be maybe not the extinction level event in and of itself, but it can be the beginning of the end, for want of a better phrase.
Yeah, it's really incredible to think that we could be in that situation. But also, I really love that stat of 60% of some APAC banks are still relying on that much payments, because I've been speaking so often and hearing about the changing model that banks are going through when it comes to payments. Yeah, with the higher volume but lower value. I find that really interesting. So it's brilliant to hear that payments are still at the heart of what a bank actually still does. Now, Edward, with that in mind, in the long run, will the innovations that organizations will be able to pull from the enhanced data from, for instance, ISO, what's that going to do for not just the financial institutions, but financial organizations and services companies going on into the future?
Yes, that's the key, isn't it? So what benefits are going to come out of this in the future, and what new business ideas are going to come from it? And we have some ideas. We can see a lot of benefits around the fraud monitoring and the sanction screening and so on, the kind of services that we provide today. We can see that we can offer services around FX where we have better visibility on that. We can link through to trade documentation. We can see advantages in being able to offer credit off the back of transactions and so on. But ultimately, I think that we don't actually necessarily know everything all the benefits that are going to come. What we do know is that if you put it in place and then you start looking at the information that is there and you use your business and your analytics to review that information, then the business ideas are going to come. What we do know is that if you don't do that and you try and do some sort of mapping exercise and reduce as much as possible what you have to process through ISO, then you just won't see that information. And if you don't see it, then you won't know what to do, you won't know what more to do, and you'll miss out on the opportunities that are there. So I don't think I necessarily know every opportunity that's going to come from it. What I do know is that when you have the data, you're going to find the ideas, they're going to come to you.
Yeah, and Cyrus, can I also get you to chime in as well when it comes to the innovations that real time can bring and that enhanced data set? What do you think will we start seeing in the next couple of years?
Yeah, look, I just want to acknowledge, Edward, that's the most honest response someone can give about this particular topic, and most people are too afraid to say the truth. The reality is, yes, this is not a traditional ROI investment for an institution. It is not easy to see the long-term benefits from a dollar perspective. We can talk hypothetically on paper about things like enhanced reconciliation. We can talk about things like reducing back office manual operations. And these are very real. These are actually in place in Europe right now today. But I think for the rest of the market, it's difficult to really understand the capitalization of that investment and see how the value comes for exactly what Edward just said. So I think we should acknowledge that's pretty sharp. That being said, you asked two questions there, Doug. One was around real time and one was around the enhanced data set. I'll make one comment about real time. I think the name doesn't do it a whole lot of justice. It focuses very much on the speed element of the product and the capability. The reality is, for many of our clients at JP Morgan, the speed is not the only value proposition. The fact that real-time payment networks tend to be 24/7, they tend to be irrevocable funds transfers, and they tend to have data-rich messaging sets such as ISO 20022, almost exclusively ISO 20022, and the additional benefits that brings, like request for pay. That's really where the value lies, in addition to just being a sub 5, 10, 15 second funds availability transfer, which by no means should be easy to achieve. I've built those systems. It's very, very difficult to achieve on grand scales, but also it's just not the only value prop. So I think the name, unfortunately, doesn't do it justice. I think the second part of your question around the enhanced data set, I agree with what Edward talked about. I agree with the benefits in reconciliation, automation, and reducing manual ops inefficiencies where you have people ticking and flicking registers. However, I think where it's more exciting is the areas of data analytics and forecasting and modeling, because you're consuming in some cases 100 times more data than you're consuming in a traditional, let's call it batch ACH style payment, where you're limited to, in the US, somewhere between 16 and 18 characters, give or take. We're talking about much greater volumes of data, much more digestible data. So what does that mean? Well, it means our analytics engineers, our data scientists, they can carve up that data in a much more intelligent fashion because they have more data points for every single record effectively. And that becomes quite cool when those folks run it through their machine learning and AI engines. The other part is what I call cross-sell. So the ability to have more data in a payment while also removing the friction of our legacy payments like checks and slower ACH and non-24/7 wires is you remove the friction of the payment, which is really the commodity anyway, but all of a sudden you're transferring more data in this enhanced data set that you referred to. So think about a used car sale example. Today, when you buy a used car in a private environment, you have to either go cashier's check, take on the risk of carrying cash, or you need to take on the risk of as a seller of taking a personal check in a traditional environment, right? Once you remove that by having the ability to make up to $100,000 payment over a real-time payment rail 24/7 and include the information of your VIN number, the registration information, the buyers and sellers information, what else do you do when you buy a car? Well, you register the vehicle, you probably get a cover note of insurance at a minimum, you might have finance on it, you might have extended warranty. These things a bank can't offer today because they have no idea that's what you're purchasing. All of a sudden, the parties to this transaction can now start to see, well, Cyrus is buying a car from Doug. It's 25 grand. It's this many years old. Here's the VIN number so you can look up registration, stolen vehicle checks, write-off checks. This is it's not a huge amount of money theoretically to be made in this particular use case, but I like it and I've been using it for a long time because we helped design this back in Australia. It's not got all the bells and whistles I'm describing right now. And it's actually one of I can't mention the name of the client, but we're actually working on something here in the US very similar. And I think it's a really relatable example to once you take the friction away from the payment and then you look at what the data that you can carry with a very relatable transaction like buying a car, which many folks watching this video will have done, you can start to see those benefits appear. Now take that and apply that to other industries. You can start to see how Edward's point of you don't really know what those benefits are, but you will not see them until you see the data flowing through your system. Case in point.
With that in mind, we've had these brilliant innovations because of that enhanced data set and real-time payments. Now I want to throw in an extra benefit from real-time payment that maybe hasn't come to fruition yet, and that's interoperability between the real-time payment schemes that we've seen across around the world. Do you think that's actually going to become achievable, and if so, when?
I think the short answer is yes. However, interoperability is really a means to an end. So the question might be more, why do we need interoperability? What are the benefits of interoperability and what are we trying to achieve? Because connecting two market infrastructures, which is the traditional view of interoperability, while very possible, it's been piloted in multiple scenarios for cross-border real-time payments from a technical pilot perspective. But really, what is that trying to achieve? Well, it's trying to achieve cross-border real-time payments. Now, you talk about interoperability and global, but the reality is there are markets around the world that have multiple real-time domestic payment services, right? If you include things like push to card on our debit card rails, if you look at the US where we have both TCH, RTP and PWS and Zelle platforms, you have multiple domestic platforms in a couple of markets already. Canada is not too far behind to have a similar scenario across their Payments Canada, various Payment Canada and Interac payments environments. So I think it's not just a global question. And so to answer the global question, interoperability will come. Will it come by connecting the systems together? I'm not entirely sure. I think technically it's possible, but where we're really going to struggle is the operating model. Think of fraud, disputes, foreign exchange, How do we get liquidity moving from central banks 24/7? Because in most markets that does not happen. So I think it's really around the operating model that will be the most challenging. The technical stuff, frankly, we can prove out. If I can send you an email in a matter of seconds and it can go from the US to the UK, then why can't I send the data of a payment? It's not really rocket science. It's the operating model behind it. And then when you look at and like I said, there's plenty of pilots. It will take some time to iron out the details, but it will happen. I think what's more interesting to me is, and this gets highlighted more in the domestic space, especially in the US, where we're launching FedNow in 2023, the Federal Reserve's new real-time payment environment. I think interoperability no longer becomes just a question of connecting systems together. While that may very well be a long-term outcome that we achieve, I think we will see players who participate in more than one network become the pivot points for interoperability. So JP Morgan is obviously part of Zelle. We are part of the Clearinghouse's RTP network, and we will be part of the Fed's FedNow network. We're part of their pilot right now. And as a result, we become this pivot point, the top of the pyramid, if you will, where transactions can flow to us from our clients, and we can then help serve them across multiple rails. That means we can offer them a faster real-time payment product, and our job is to determine which rail to use it. We shouldn't be selling rails to clients. We should be selling a payment product that's fast, that carries a certain amount of data, that meets their specific requirements. And then we determine under bases of account reach, and cost, and functionality, which is the correct payment rail to use. So interoperability is actually more about how do we service our customers reaching the correct endpoints with the right functionality, and then go backwards from there. If we develop the technology solution, as banks have, and I can put my hand up and say I'm guilty of this as well, developing the solution from a bank-only perspective and for the sake of making development, I think we miss the forest for the trees of your original question of why do we need to collaborate with new market entrants, the likes of fintechs. It's because they think in that different fashion. And I think it's important that we start to acknowledge that and recognize the value of that different viewpoint.
Yeah, I think that is important to reinstate. It's the fact that banks can't be everything. They can't, even if payments do change, there has to be a point where a bank is a bank. Now, Edward, I'm interested in your expertise when it comes to these payment rails and working on that architecture yourself as well. Where do you see interoperability within RTP schemes going in the future as well?
So in terms of interoperability, I see more of it coming. To Cyrus's point about propositions, we're seeing increasingly that it's about it's you're saying about putting the customer first. And so you say you want to make a payment, and do you want to make an immediate payment, or does it matter how quickly? Is cost or speed more important to you, rather than which rail do you want to use? So we're seeing customers moving away from offering propositions to our customers are, for example, this is a CHAPS payment, or this is a SWIFT payment. They're just saying this is a fast payment, or this is a cheap payment. And then we can help them to decide which rail it goes across in the background, which system is the most appropriate in order to achieve that goal. The standardization that is coming over the next couple of years is going to make it far easier for us to be able to manage that from a single data set. So we get one data set from the client, and then we can put it out to the different systems because they're operating in broadly the same way and using the same standards to do so. And we are seeing the barriers breaking down between countries in terms of interoperability. So we do see these, a lot of particularly the real-time payment schemes working quite closely together. So we've seen these pilots between Singapore and Australia, and faster payments in the UK, where we're getting cross-border settlement and confirmation of credit to customers across border happening. So I do think that happens, and I think that the standards that are coming in are supporting that. We're seeing the enormous consolidation in Europe with the drive towards TIPS and RT1, which has taken away a lot of the friction within the European countries. P27, again, another initiative in the Nordics, which is breaking down the barriers between the different countries and settlement of different currencies. But I think that when we go beyond those initiatives and we look at the solving the customer pain points, that's where I see the correspondent banks having the role to play there in being the link between these different countries. I don't see the market infrastructures coming together that much more. I think it's going to be the role of the banks and the payment service providers to be that glue between the different regions. I don't see that changing.
Yeah, and I think it is almost natural, isn't it, for them to kind of take up that mantle of being that connect.
Yeah, I mean, it's their space.
Yeah, brilliant. Well, with that in mind, then we're going to start wrapping up, but I want to kind of leave our viewers with a kind of forward-thinking set of questions. So, Cyrus, if I could come to you and ask you, for JP Morgan, what are you guys kind of looking at implementing potentially with RTP, and what's really exciting you effectively in the coming years?
Yeah, good question. I think there's a lot. We have a really quite an aggressive agenda in our overall payments ecosystem. For real-time payments in particular, we currently have the largest global footprint of any global transaction bank. So it's very impressive that I walk into an organization and I have the benefit of that behind me to run the product. But that won't stay in place forever if I don't keep moving and we don't keep moving. So we have a very aggressive roadmap as more and more faster and real-time payment schemes launch around the world, even ones that maybe we don't traditionally call RTP, that run over, for example, a debit rail, or they use a wallet-based solution. These all, to me, are kind of faster funds movement, and therefore they fit the same banner. So we have a really aggressive roadmap to evolve and expand even further to more of those unique systems, as well as traditional RTP markets, new ones going live all the time. In addition to that, I think one of the biggest excitements for us is going to be launching real-time payments request for pay in the US this year. We'll also be launching in other markets around the world. We've been talking about this as an industry for quite a long time, certainly as long as I've been involved in real-time payments. And I don't think we've really seen a deployment of the capability in a very commercial sense to date. So I think it will be very exciting. I think it will not be an easy road to grow adoption. Similarly, how RTP has been a little bit of a longer growth pattern here in the US, but certainly it's exploding right now in the US. I think request for pay enabling the ability to receive money, I think is very, very impressive. And I think the capability request for pay will give us, and some of the pilot clients that we're working with, the biggest names you can imagine on your Forbes 500, frankly, 100 list. That's what makes me excited, is the names and the innovations our clients are pushing on us, our technology partners are pushing on us. I think that is going to be the big change for us, and I just hope I can hang on for the ride.
It's after payments, maybe after 10 years, the previous 100 years being quite stagnant, we're now really in the exciting time. So Edward, if I could chuck the same question to you then about Bottomline, what are you guys looking to kind of take a role on in this ever-changing industry, and remain future-proofed for your customers and people going forward?
Yeah, sure. So it's a different answer really to the one Cyrus goes. So he's sort of talking about a really new space with request to pay. That's not even something that people are really doing today, using the systems that are available. I think what we're looking at is something probably sort of a little bit more basic. If we look at what we've provided so far today, we've looked at providing connectivity into schemes and managing messaging between parties. And we've looked to do that as efficiently and easily as possible for our customers. I think where we're going now is we're moving away from, we're not away from that, but we're providing that. But on top of that, what we're looking to do now is to really try and process transactions. So we'll get away from just being a connectivity provider and a messaging provider to helping our customers to manage the transaction, to see it end to end, to provide services on it, to understand the underlying transaction if it's a payment, or to ensure that the payment's integrated if it's a securities transaction, or even if it's a corporate action, for example, to look at how we provide an end-to-end process around that. So if it's a general meeting, really getting the end-to-end flow on that. And so that's the space that we're really trying to move into and provide added value services for. And that's what our customers are asking us for as well. So we're going beyond just connectivity and messaging now and really trying to process transactions.
That's absolutely brilliant. Guys, thank you so much. I think that's all we have time for. And thank you also to our viewers. You can catch the rest of the series and much more over at www.fintechf.com and of course YouTube and LinkedIn, where I'll see you then. So thank you very much, guys, once again, and I'll see you soon.